Welcome to the Millionaire Journey Podcast. The goal of this podcast is to guide and empower you on your journey towards financial independence. Here's your host, Glenn Yaney.
Today, my guest is Patrick Grimes with Passive Investing Mastery. Welcome, Patrick.
Glad to be here, Glenn. Thanks for having me.
Yeah, excited to have you on. I know that sounds like you have a vast array of knowledge over all different types of alternative investing. If you could just tell us a little bit about your how you got to where you're at today.
Yeah, well, I started out probably like many of your listeners in corporate America, just fighting my way into being successful and in my case, I was a mechanical design engineer and did automation and robotics. Tough industry, a lot of innovation, custom work. The company I worked for, the machine design firm owner, said, I was asking him like, hey, where should I be investing at? And he said, man, my only regret was not investing more into real estate sooner. And that was interesting because I thought he was going to say, oh, I have the inside lead on these 5 companies and, tech startups and, medical device or what, because we were doing solar cells and defense. But he said, make your money in high tech, invested in alternatives. And so that's how it got me into it originally. I lost everything in 2009 and 10 doing some speculative real estate stuff. Didn't really know what I was doing, was investing for huge returns. And turns out you can lose it all when that happens. So learned my lesson. But over the course of, the coming years, I got a master's in engineering and an MBA and recovered financially and started investing in single family, then apartment buildings, and then some energy. And now we're in private credit loans for real estate, as well as a legal fund that does loans to attorneys. So a lot of non-correlated alternatives.
Awesome. Let's talk about private credit first, and then we can go into the other stuff. What kind of private credit do you look for?
Well, so I believe that your portfolio should be in non-correlated alternatives, not just the word diversification. I don't like that because people think, oh, I'm diversified in stocks or I'm diversified in real estate because I'm in a REIT, which all of that's bonkers. So I think that you need to get into completely different asset classes that have different market fundamentals. So that's why we're saying like we'll lend in the legal space to attorneys that have collateral, and they tend to be busy in good times. They tend to be busier even in bad times when people are litigious. Same thing. And we'll lend in, just like how we'll lend in real estate to operators that want to buy a property or improve a property. We'll lend against their collateral, which is a property, right? It's just an asset, and we'll put liens on in either case, and we'll collect proceeds.
So when you is this a lien on with the attorney or their clients?
Well, so you don't lien on the clients. There is a contract, which is in our case, they're contingency fee agreements, and that's a corporate asset that can be valued, just like a building can be valued by an appraiser. You can have a law firm valuation specialist go in and review the assets of an attorney, which are these contingency fee agreements that entitle those attorneys to settlement payouts. And if in our case, if it's pretty late stage in that lawsuit, and you can assign a real value to it, and these guys can come and say, "Yep, this actually looks like it's going to be worth quite a bit. We can then do a loan on it, and then you can put a lien against those specific contracts against the attorney's assets to make sure that you get a priority position payout when those settlements commit."
And where does the actual funds go? Does it go to the attorney?
So litigation finance is a huge wide range of industry, just like how real estate and oil and gas. And so there's a lot of ways to invest. There's also a lot of ways to be super speculative and lower risk. And we tend to be not the early on speculative gamble, but the lower risk, later stage, just before settlement. And instead of lending to just a plaintiff or just one defendant, we're lending to a law firm typically, and usually collateralizing a large amount of cases, hundreds or thousands of cases, individual lawsuits, right? A lot of different legal disputes in there. So that for us provides a fairly lower risk profile, right? Because they're at a first loss position, we're not, right? And so we look at a lot of their collateral in a big basket, and we'll get paid on the winners first before they do. And so that's kind of how we look at it.
And so the person that benefits, so that when you say give the loan, it's generally to the attorney that's trying to like grow their business. Is that what's happening?
Yeah, just like real estate operators, they want to acquire buildings or improve buildings to provide housing to tenants, right? These guys, these attorneys, these legal operators, they may want to acquire new clients to increase the size of their docket, which means they need marketing. Or maybe they just need operating expenses to get their court fees, filing fees, their hourly rates across the finish line so that they can provide access to justice for those that otherwise couldn't afford it.
Yeah. Okay. Yeah. So, because I've always heard about the, it's like almost like a cash advance for the, I guess I don't know if it's the plaintiff, but somebody that's expecting a big lawsuit, they might give like a cash advance to them. Is that something like another area, I guess, of finance for?
Outside of our scope, like there's like just like in real
Okay.
estate, there's a million ways to participate in the industry. And yeah, there's people out there doing personal injury stuff, lending directly to harmed. There's people out there lending to defendants, people that were sued. And in our case, we're making a bet on the attorneys being busy and then underwriting
Successful.
those, and underwriting those cases such that they're kind of in that latter stage where it's not so much is the defendant liable or did they cause it. It's more like, okay, it's been established, and it's not so much what in the world is the settlement going to be? We got a pretty good feel based
Yeah.
on where the negotiations are, other cases, and then you can diversify it across each attorney has lots of cases, and then put lots of attorneys and law firms into one diversified fund, and you got a pretty good diversified. We call it the portfolio, diversified litigation portfolio. It's a pretty good diversified return, which, man, it doesn't seem as predictable as real estate, but real estate's not really that predictable. We keep learning that over and over again. But what's interesting about the legal industry is that what's predictable is it's not going to rise and fall with real estate. There's zero correlation. And to really have stability in your portfolio, you have to be in uncorrelated investments.
Yeah.
Right. And that gives you true stability, right? That's true security. So that's why it's very attractive.
That's awesome. So what is passive investing mastery? What do you guys cover?
So we do sponsor alternative investments, but my passion project is actually educating investors, because as an automation and robotics engineer, I was doing really cool projects with some of I would back 15 years ago, I was working with Waymo on Google's autonomous car. Before it was just still a figment of imagination, doing satellite solar cell assembly stuff for Lockheed, catheters that go in and ablate the heart valve stuff. I was working with Tesla. I was working with Toyota before Tesla took over the facility, actually. And then I was working with Tesla on robotic assembly cells for their motor. Just doing a lot of amazing stuff. All these people working in these facilities, some of the smartest people on the planet, no idea, including me at the time, any of these other options existed, right? We're very clear that there's 100 stocks that you can invest in, and maybe crypto, or maybe a couple startups, or maybe your buddy knows, whatever. But nobody knows, well, what's the full deck? What are the 50 alternative strategies that provide true resilience and non-correlation to the volatile waves of the rest of what is popularized, right? And so I created a platform where, and it just kind of came from, there's a couple guys where I was just trading the baseball cards of alternative strategies with, and it was just a couple of us, and kind of came from me finally going, but hey, here's my hand, right? People loved it. So we just said, okay, here's the whole deck. And we created a series where it's an alternative investing mastery series where every 2 weeks, it's been every week recently, but every 2 weeks, we get on with completely different strategies, 2 or 3 panelists that specialize typically for decades in a completely different kind of investing. We're doing one in timberland. We've done one in gold mining and Forex and parking lots and bourbon barrel cask or vineyard investing, all kinds of completely different non-correlated strategies that help to provide like, hey guys, here's the 50 plus other completely different alternatives to choose from.
Yeah, I love it. And really it comes down to when you come to the niches of certain types of investing, I believe that you probably can become higher returns, because when you get to real estate investing, everybody kind of understands it. So there's more buyers, so it drives the cap rates down and the prices up. But when you have more of specialists come in and they, when it comes to vineyards, or what I've seen is whiskey barrels. I've seen people do those, and it's always interesting. But it's when you become an expert in that field, there's less competition, and you can kind of it's almost nothing's guaranteed, but it makes it more of a where it's not exactly, there's some arbitrage to hit. So
Agreed.
So yeah, so so right now you're focusing on the legal and what's the newest investment that you're looking at?
Well, we have 2 funds in real estate, which really help to give you an opportunity to win from the upside of this downturn that's happening in commercial real estate right now, both from the debt and equity side, because it's incredible right now that banks are on the sidelines while interest rates are high, and we can lend at very high rates for good properties. So we have a debt fund that provides for great returns, monthly, predictable cash flow at varying liquidity options. You can pay 90 days, 3 years, there's options in between. And that allows us to be a source of relief for those operators that need help from a debt perspective at a time when banks are kind of ignoring the asset classes that we're focusing on, which are mostly commercial real estate and small balance. But if those operators, they just want out, well, it can be the source of relief to them too, because we have an acquisitions fund, which just acquires commercial real estate. And so if they want out, then we can help buy it from them in cash and take advantage of buying low. So we lend high and buy low. And this time it's the best time of my life to be lending high and buying low in commercial real estate. So those two sister funds are doing great. And then we have our litigation finance fund, which is our diversified litigation portfolio, providing true non-correlated returns.
Hey guys, if you want to learn more about our deals we're investing in, go to our website and sign up for our free ebook, 10 Reasons Mobile Home Parks Outperform Other Real Estate Investments. We won't spam you. We'll just keep you updated on the podcast and the deals we're working on. Now, back to the show. So what's the main focus on the real estate aspect? What are they looking, multifamily or?
We have not seen multifamily pencil with certainty yet right now.
It's
that
tough.
gives me the confidence to bring it into the fund. Now that may change, and it looks like things are becoming a little bit better, but the fundamental expenses and outlook for rent growth, the oversupply in the market, there's a lot of things right now that there's some markets where they look advantageous. We've seen a lot, and I also want to say we've actually excluded office from any of our affiliate funds. So there's just a lot too much uncertainty for me.
Yeah.
To not only in the current, like I think in June 2025, it was over 10% vacancy in office space. And I struggle with the long-term absorption of that post-COVID. And I see potentially a decline with AI and the less need for people to come in, blue-collar jobs. So I'm not sure about that. But we've really seen some incredible opportunities, post-COVID here in some markets for industrial and retail and manufacturing, where you really see strong reshoring happening that is only growing with the latest tariff wars and challenges that have happened. And whereas I think the numbers I looked at for industrial were close to 2% vacant. That's incredible, right? So there's huge disparity in vacancy rates between those two, would show how strong the asset class. Also, we've seen some retail where great. I mean, these people really struggled. These operators got pummeled and hammered. They're still good underlying assets, but these people just need out. So we've been able to swoop up some of those.
Yeah, generally, I guess there's all kinds of real estate, but there's the good locations is pretty important. But with the industrial, so that is storage units considered industrial, or is that not industrial?
I would not consider storage units industrial. No, I'm not sure what that would fit into. But industrial, in my mind, you're talking about typically triple net leases with long-term tenants. I mean, that would be the general thesis, where you've got warehousing or you've got manufacturing, something in there where that's typically what that falls into. When it comes to self-storage, I have yet to make an allocation to it. Self-storage units 10 years ago, you used to be able to, there was pretty commonly pocketing 40% IRRs, 60% IRRs on some of those. Much harder to do today. What I'm seeing more is like high teens or mid-teens. It's a lot harder to find places to build new without already being pretty strong competition, but there's people doing it. And the other thing about self-storage that I struggle with on a regular basis is that it's a month-to-month, and typically the rents are not locked in month-to-month. So self-storage guys are like, that's amazing because I don't have to wait for a year to raise my rents, but that can help you grow fast. Can also be less of a competitive moat if somebody builds a storage unit next door and maybe they're an institutional buyer that doesn't need as strong returns or have deep pockets, and they can come to the mat with their rents, and then you may find yourself losing occupancy and needing to lower quickly. Whereas if they were year leases and have a little bit more insulation and time to plan, I just haven't found the opportunities yet in self-storage that really excite me.
Yeah, the problem with self-storage that I've seen is it seems like they don't have a lot of issues with zoning. Like it seems like there could be like a hotel building, and then they build a storage unit right next door, or a mall. There's a storage unit. It's like you can build pretty much. It seems like they go up everywhere, and it doesn't seem. I mean, I've never done development, so I don't know, but it always seems like the storage units could multiply pretty quickly. And that's been always my thought is like, if there's a piece of land, I'm like, it's either going to be a car wash or it's going to be a storage unit. And but with industrial, so what? Just a few things. I think I don't know. I've never tried to invest in industrial, but I would say that what I'm thinking is like big, large warehouses. And with those warehouses, it becomes less tenants per unit. So what, like, doesn't that create more of a risk to, like, say if the tenants decide to like leave or go out of business?
Yeah, so it's important to make sure that you understood the stability of your tenant and then the solvency as well as the length of their lease. But it's also the case that we're buying them in a portfolio, right? In our acquisitions
Yeah.
fund, it's an evergreen fund, and you don't just buy one. We've got a
Yeah.
bunch of them in there, right? And so there's a lot of ways in which you limit that risk. But it also is really difficult for manufacturing companies to pick up and move. It's hugely
Yeah.
expensive, and it's a triple net typically case where everything passes through to them. So you kind of had your fixed income, and that income traditionally has built-in escalators. So it's a fairly predictable business with a much bigger competitive moat from people trying to leave it. But then again, if you're in areas where there's high, strong demand, then
Yeah.
there's a likelihood you'll be able to occupy it. And if you're in a fund that can allow for a bit of a gap, right, then that allows for some downside protection.
Definitely. So where can people find you?
PassiveInvestingMastery.com is our website, and we have our 3 affiliate funds at the top: the predictable cash flow income fund, the acquisitions fund buying commercial real estate, best time of our life for doing that, and then our diversified litigation portfolio. At the top, just below that, we have our Mastery series. I welcome everybody to jump in there. Every week to 2 weeks, we dig into completely different non-correlated alternatives. If you are interested, I have a website or a download, which is Patrick's favorite alternative investment strategies, because I get a lot of them. Patrick's favorite alternative investing strategies to start building true financial security today. And you can find that at investwithpatrick.com, investwithpatrick.com. And that right there on the top page, it just says my favorite, that list them all out. And then if you're interested in any of them, in subsequent pages, I've actually described them and how they work and how to get access to them, because it's the most common question I get asked, is something that has just a huge swath of alternative strategies to choose from.
Yeah.
So check that out at investwithpatrick.com. I also give away a book. And if my story that I've shared here today about kind of being an automation robotics engineer, losing it all in real estate and coming back and then building portfolios and then finally getting out of the grind and being a full-time investor, if that was interesting to you, then feel free. Go to passiveinvestingmastery.com/book. I give these away for free. You can download the ebook, or you can download the ebook and get a copy. We signed it. We send it out. It was an Amazon bestseller. I tell my whole story in here. Some other really cool people. Phil Collins, the guitarist of Def Leppard, an actual rock stars in here. There's a Navy SEAL, Tom Ziegler, Kevin Eastman, Dennis Waitley, entrepreneurs, athletes. It was such an amazing book to collaborate on. I tell my whole story, the ups and downs. Happy to hand this out to anybody who would like it. And that's passiveinvestingmastery.com/book. And don't forget to set up a call. I mean, I have a lot of slots on my calendar still open just to give back and talk to investors. Wherever you're at in your journey, I'm happy to help. If our investments are a good fit for you, that's great. If not, we can get you pointed in the right direction. We certainly know a lot. We have a huge menu of them on our website.
Awesome. Well, that's exciting. And thank you so much for being on the show.
All right. Thanks for having me, Glenn.
Thank you for listening to the Millionaire Journey podcast. Please rate, like, subscribe, leave a comment, and share with somebody you think would enjoy listening.